Hello, fellow Rebel Capitalists. Hope you're well. I am here with my good buddy, Peter Boockvar. Peter, number one, thanks for coming on. And number two, has the world ever been crazier?
The world is always crazy. Was it talking to what degree? And I would say the degree is pretty hot right now.
Yeah, for sure, for sure. So let's just start, I guess, right now with Trump trying to fire Powell. That's kind of what's big in the news, and a lot of people are blaming today's decline in the dollar on Trump trying to get rid of Powell and the Fed independence. So what's your take on the kind of all the drama, let's say?
Well, I think Trump realizes he's damaging in the short term, the U.S. economy. And he's hoping that Powell comes along like Superman and saves the day with rate cuts. There are a couple things with that. Are rate cuts going to solve the economic challenges that we have right now that are caused by the tariffs? Or is it going to be spitting in the wind and just exacerbate inflation from more than just a one-time step up in price that tariffs theoretically are, but maybe a longer-term flow through? Powell's focused on Powell and what he thinks is best in terms of the inflation fight. I think that the key line that he gave when he spoke, I think it was last week, was, and this is something he said continuously as he raised interest rates. And unfortunately, he was saying the exact opposite when he was dramatically easing during COVID. The tagline being, you can't have strong labor market growth unless you have price stability. Of course, during COVID, when they were easing and they ignored the inflationary pressures, he was more focused on the labor market and less so inflation, but then he obviously learned his lesson. He leaves May 2026. The last thing he's going to do is walk out the door and have inflation running up in his face and bowing and kowtowing to Trump. So I think he's going to hold steady. And that's not to say he's not going to cut interest rates. I think at the labor market, if the unemployment rate can start to tick up, which I certainly expect it to do so because we're basically heading into a recession right now, he'll cut. But I think it's going to be more methodical. And anybody who thinks that the Fed's going to come around and save us from what's being thrown at us right now, I think is badly misplaced faith.
What do you think about the CPI recently, Peter, going down to 2.4? And the way I didn't get into too many of the details, but I did a video on it, and it looked like the main reason was because of energy. That was the energy prices going back to March, where they weren't as low as they have been in April. And I know oil's down big today, but if we get down back into the 50s, I mean, it seems like the next print could be very close to 2% along with the PPI stuff. And it seems like that gives them a lot of cover to cut.
Well, the thing with that is there's one thing to see a spike in inflation, a fall back down to 2%. There's another thing to stay there. And landing at 2 is, getting to 2 is one thing. Keeping it there is another. And it remains to be seen whether it stays there. On the good side, prices are going up over the next year. Whether it's just a one-time thing or a multi-year flow through, we'll have to see. But I go through a lot of earnings calls, and Fastenal last week said that they're raising prices. An interesting conference call that I went through on Friday, or actually on Thursday, was Fifth Third Bank. And the CEO said he's spoken to about 50 of their clients, everything from manufacturers to people they're exposed to in the industrial space and a variety of other industries. And everyone is looking to push price. So goods prices are going higher. Now, whether that gets absorbed by the consumer, we'll have to see. Whether it's going to have to get eaten in within the supply chain, we'll have to see. But everyone is trying to push price right now on the good side. And if you're a service business that uses, imports as part of what you sell, well, you're going to be looking to do the same also. On the flip side, the rental component on the services side should continue to decelerate. That'll keep a lid on inflation. What the net result will be, obviously, we'll have to see. On the rental side, though, I do want to emphasize that we are sowing the seeds for a reacceleration in rental growth, likely in the middle of 2026, as we're seeing a short reduction in the pace of new multifamily supply. I do think on the demand side of multifamily, still going to remain very good because it's just unaffordable to buy a house for many young people. So a lot of the supply that was massive in 2024 and into early 2025 is going to get absorbed. And exacerbating the lack of new construction is the rising cost of steel and aluminum and lumber and a variety of different things because of the tariffs.
Right.
So sustainable is the key word on inflation. And I don't think when you look out over a 3-year time horizon that inflation is just magically going to sustain itself at around 2%. Yes, I expect a recession, but I think the net result is going to be the stagflationary type. To what degree, I don't know. But I think there's a lot of friction out there on the pricing side that, the salad days of 1% to 2%, I think it's going to be on a sustainable basis. I keep using that word.
Yeah.
I think it's going to be tough to achieve.
Yeah, I think it's time horizon. So I go back and I look at the recessions we've had, and they're all disinflationary. Even in the 1970s, they're disinflationary. And so I don't know how you push prices in a recession, but that's not to say that coming out of that recession, that prices don't reaccelerate. And so you can have a stagflationary decade for sure, like the 1970s, but even the recessions within the 1970s are disinflationary. So basically, over the short run, you get down to, let's say, 2%, 1.5, or something like that. But then when you come up out of that, those underlying inflationary pressures still remain, which takes you back up to 3, 4, 5, 6.
Well, yes, I agree. And it also is the question is who's going to eat it? The tariffs. I mean, there are price pressures everywhere, and price increases are going up to who can best absorb it. Like, it doesn't necessarily mean the consumer it'll get passed through because there may not be pricing power in the the downturn and the disinflationary history that we've seen, but somebody's going to have to eat it. So when we say inflation, well, inflation at what point of the supply chain? At what point flowing through from the initial producer or absorber of that and the end customer? There's inflation. It's just a matter of where it ends up, but it's still there. And you take like sort of a pipe. There are going to be bubbles popping up within that pipe, and whether it flows through to the other end, we'll have to see. But somebody's going to get hurt in terms of their margin at some point, whether it's the household at the end market, whether it's intermediate term parts of the supply chain. But a lot of this stuff's going to have to get absorbed. But on your point on energy, yes, the decline here is certainly going to help. It's going to ease some of those pressures. As we know, oil is a major input. But on the other hand, you have natural gas prices that have been elevated. So there are pushes and pulls here across the board.
Yeah, I always try to say that the stuff that you buy at Walmart going up in price. So like the stuff you need goes up in price. The stuff you want might go down in price. It kind of gives a balancing act. But that stuff that gets hit by the tariffs, to your point, someone along the supply chain has to absorb those. Do you think let's assume for a moment, and I don't know your view on the dollar, but let's just assume that it continues to go down on the DXY to whatever, 90 or something like that. I think it's a support at 90. Does that make the tariffs more difficult to absorb? Because I think about if I'm a Chinese widget maker and, all I care about is my profit in yuan. I don't necessarily care about my dollar profit. So if I, have to lower my dollar price, I don't really care as long as the dollar is going up, because then I still get the same amount of yuan. But if the dollar is going down, now I got big problems because I can't lower those prices. And therefore you would expect to see the U.S. consumer have to absorb more of that price pressure than the Chinese widget maker did in, let's say, 2018 when the dollar was actually going up. So how does that play into everything you're talking about?
Well, I'll add to that because about 40% of imports into the country are intermediate term goods that end up in a finished product. So not only is a U.S. importer having to pay the 10% tariff at a minimum and more, obviously, if they're exposed to steel, aluminum, autos, or other things, but now they are importing with a weaker currency. So it is a double whammy on U.S. importers. And like you said, the consumer is also then going to pay this too, because the exporter to us is going to be able to, is not going to be eating it. We are. So
Right.
this whole tariff strategy was predicated on, well, in the short term, let's have a stronger dollar to mitigate the impact on U.S. importers of that product. and reduce the impact on the end consumer. Now that's totally blowing up in terms of the strategy of how the tariff would go.
Yeah,
Rollout would go.
yeah, and I think people also forget about the lack of tariffs on inputs outside of the United States. So, as an example, I don't know. Do you know who Mr. Beast is?
Yes.
Okay. So he has this brand of chocolate bars. I think they're called Feastables or something like that. And he was saying that he manufactures most of the Feastable chocolate bars in Peru. But he said that even with the chocolate bars that he sells in the United States, it's still cheaper to make them in Peru, even with the tariff, because he doesn't have tariffs on all the inputs that go into the chocolate bars. Whereas if he produced those in the United States, sure, he wouldn't have to deal with the tariff on the end product, but he has to deal with the tariffs on all the inputs.
Absolutely. I mean, they're George, we can draw so many unintended consequences. Let's take another one. And I'm going to take this right out of Peter Navarro's mouth when he was on CNBC a couple weeks ago. And he basically said what he, in his ideal world, what he wants. Take an automobile, for example.
Yeah.
He said, and I'm paraphrasing, I want to make the transmissions here. I want to make the engines here. I want to make the tires here, in addition to the finished product. So what you're going to have is, you're going to have, in his ideal world, you'll have everything that's put into that automobile plus the finished product made in the US. The problem is, though, is you're not going to have a consumer that's going to be able to afford to buy it, and you're going to have priced yourself out of the global marketplace, because you'll never be able to sell an affordable car from the US to an outside market. So if I'm a US manufacturer, I'm going to be making in the US for a higher income consumer based in the US. And if I want to sell in Asia Pacific, if I want to sell in Europe, I'm not making them here to sell there. I'm going to build a factory in Europe. I'm going to build a factory in Asia to serve those markets. And I'm not going to be building any of that supply chain in the US. That supply chain is going to be outside the US. So we are literally going to have walls around the country, both in terms of producing here and who we can sell to. So there are a lot of bad connecting dots we can draw here, George.
Yeah, I almost think that, and I hate to poke fun at people, and I'm going to stand up for them here in just a moment, but it almost seems like if you take the whole MAGA approach to economics to its logical conclusion, you get to North Korea. Is that? Yeah, I'm not trying to make fun of anybody, but you've got this like totally enclosed economy, or circular economy, let's say, where everything that is consumed is produced at a local level, and you just don't do business at all with the rest of the world. What do you think? Are we headed to North Korea?
Well, it reflects an incredible ignorance of global supply chains and how the whole world has benefited from them. And I don't think realistically speaking, we're going to start making wire hangers again in the US, or sneakers, or backpacks. There's a lot of things we're just not going to make here. And there's this belief that US manufacturing jobs just started to plummet, after NAFTA. Ross Perot talked about the great sucking sound, with jobs to Mexico and China entering the WTO, and they stole all of our jobs. Now, I don't want to downplay the impact. There's no question that a lot of supply chains were shifted around the world, but manufacturing jobs as a percent of private sector employment has been falling since the 1950s. 1950, we were about 35% of total U.S. manufacturing as a percent of total private sector employer. And it's been falling since then. Now it's about 8 or 9%, but it's actually stayed pretty steady at 8 or 9%. And the main reason for that decline has been automation and productivity, right, and the ability to produce things at cheaper prices with lower labor costs. But on the other hand, we've built out this incredible service side of the economy that has a major surplus with the rest of the world. And yeah, it would be nice if we made more stuff here. It would be nice if we were less reliant on China for some of our key inputs. But there were many ways of going about bringing that to more friendlier countries like Vietnam. But then we want to tariff Vietnam by 46%. There are ways of moving that critical production to other places without blowing up the global economy. I started thinking this morning, before like every day we wake up, we just obviously don't know where we're going to wake up to. And I wake up with the S&P futures down 50. And I'm like, it's like the restaurant that sees a rat in the kitchen and their desire to kill the rat is to blow up the restaurant. And I feel like that's what we're doing here.
The pushback I get with that, Peter. So let me play devil's advocate here, because I don't want to, poke fun at the MAGA people, because they do have a point. They can say, well, look, you look at the Rust Belt, you look at all the high-paying jobs that we used to have, and whether that's automation or offshoring, this is something we've got to do. Well, that's just always the argument. We have to do something. We have to do something. And if I say, well, let's just do a cost-benefit analysis, and the cost might outweigh the benefits, they just brush that aside and say, well, I don't care, because we just have to do something. And if Trump is going to come in and shake things up, well, then so be it, because that's what we have to do to get the United States back on track for the long term. So this is the argument. What's your rebuttal? And then what would your solution be? Because I want to acknowledge to all the folks out there that have lost their job or whatever, that yes, I get it. We should be doing things to make sure that the U.S. economy is running on all 8 cylinders, and to make sure that we don't have as much of a dependence as we do now. But my view would be there's other things that would be a much better solution for this problem than just taking a snow globe and just shaking it as much as you possibly can and seeing what the outcome is. So
Yeah, great analogy. So I understand all those concerns and what has happened to many industrial towns and losing that to China or Mexico and I understand that, and I understand the goal of the administration to stop this and bring back certain manufacturing. But a couple of things to that, and it's not just okay, so and so stole our jobs. There's a lot of things that have gone on in the U.S. economy over the last 20, 30, 40 years. We financialized the U.S. economy. We've relied on cheap money, misallocations of capital, the stock market driving the economy rather than the economy driving the stock market. We've made the cost of living in a home unaffordable. I mean, the Fed has turned the U.S. housing market upside down multiple times over the past 20 years. And the average price of a home just over the past 5 years is up 50%. So people can't even afford to buy a home. So I think there are a lot of sort of pain points that I understand are being felt. But to say that, okay, it's because China entered the WTO and we're making more cars in Mexico, is the main reason. Well, I think it's much broader and nuanced and deeper than that. And, the one thing about manufacturing is automation, since the history of the world, has come to manufacturing. Look at a farm. A farm is seeded by a tractor or a combine that actually now doesn't even have a person in it. Are we going to go back and hire people to literally take their hand and stick it in a seed bag and start throwing it around? No, it's just not going to happen. Automation has changed things and will always change things no matter how many jobs we want to try to reshore. So maybe we'll build more manufacturing plants here, but they're going to be highly automated because that's the only way we'll be able to compete. Now, to the question of what other things can we do about it? Well, there's obviously education, there's retraining programs. There's a lot we can do. I mean, we've created this incredible technology sector in the country. We make that. We've created that out of our minds, the software and the data centers and everything that's needed. So it's not like there's not demand for manufacturing and construction jobs. We're just doing different things. And It's easy for me to say because I didn't lose my manufacturing job. So I understand where the angst and the pain and the difficulties and the disruptions that all this has caused. But are we going to be better off with the strategic initiatives being taken right now? Let's go back to 2018. Luckily, we don't have to go back that far. The last time we tried this with tariffs, and a lot of it was on steel and aluminum and other things. Well, what came of that? We wanted a reshow. We wanted to protect steel and aluminum. Meanwhile, Alcoa, a major U.S. aluminum company, was saying, don't put on aluminum tariffs because they also import a lot of their aluminum into their smelters into the U.S. from Canada. So you had an aluminum company saying, don't put on the aluminum tariffs. And we had more job losses from the users of steel, and those companies make things, than those jobs that were created within steel. And what happened? U.S. manufacturing went into recession, and the Fed was cutting interest rates in response to that in 2019. So we had an experiment with tariffs, and it failed miserably. So what do? It's typical like government response to things. Well, let's try something, and it doesn't work. Rather than reevaluating what the technique and the use of what you tried, and maybe doing something else, it's okay, we didn't do it enough. Let's do more. And let's do more. It's like, okay, Vietnam with 100,000 troops didn't work. So let's just send more. And let's just send more. And let's just send more. And government spending didn't cure a problem. So let's just spend more. And, also one of the big problems here too is that Trump is working off this false premise that a trade deficit is a bad thing. And that the person or entity or whoever you have that trade deficit with is ripping you off. So I got my hair cut a couple weeks ago with Nicole. I technically, by paying her money, have a trade deficit in services with her. And I don't think she was ripping me off, unless she did a bad job with my haircut. And I think she charged me a reasonable price. We both benefited, and I have a deficit with her. Walmart is the largest employer in the United States with 1.6 million people in the United States working for Walmart. But they have a huge trade deficit with China because I think about 60 or 70% of the stuff they sell in their store comes from China. China has benefited. Walmart has benefited. Employees have benefited, and we have benefited from the ability to buy things cheaper. So thinking and like I said, we have a huge trade surplus with the rest of the world. And I don't think the rest of the world thinks we're ripping them off. So when you have this wrong belief, then nothing good comes of it in terms of initiative trying to correct the wrong belief. Now, there are plenty of countries that have trade barriers with us. I get that. Europe has a higher tariff on autos than we place on them. But there are ways of dealing with that. And instead of again, blowing up the restaurant to kill the rat. And I think I think we're now entered a China derangement syndrome. That Trump derangement syndrome, they couldn't get over him in his first term, but now we have this China derangement syndrome where everything China does is bad. We need to block them out of any trade with us, and they're ripping us up. And I understand the IP, and they have stolen from us, and they don't allow Facebook and Google, and they don't allow our technology there, and they put up barriers and so on and so on. But there's so many U.S. companies that are dependent on sourcing from China that is not replaceable in other countries. China is a manufacturing powerhouse, not just out of circumstance, not because China subsidizes them or taps their banks on the shoulder and says, lend to this business or this industry. China is the manufacturing powerhouse because they're very good at what they do. You talk about North Korea. North Korea subsidizes their industries, but they're no manufacturing powerhouse. The USSR was subsidized by their government, but they never became a manufacturing powerhouse. China became what they became because they're extraordinarily good at what they do, and that is not easily replaceable by other manufacturers in terms of infrastructure, manufacturing efficiency, cost to the buyer. I have friends that have sourced stuff from China over many, many years, and they are a very, very reliable source. So now what you have is you're going to put thousands, tens of thousands, hundreds of thousands of U.S. small businesses out of business because they can no longer get product at a reasonable price from China. And God knows the carnage that's going to take place every day that goes by now that this is not solved. Because I'm hearing a lot of really bad stories that some company is just not going to make it because they can't, even if they chose to 2 years ago to try to replace a Chinese supplier, no one is as efficient and reliable as is that China supplier. And I'm going to take us one step further because the China derangement syndrome has affected people.
I'm going to steal that term, by the way, Peter, just so you know.
You got people saying like, we are going to keep U.S. technology out of the hands of the Chinese. We are going to suppress their advancement because, God forbid, one of our chips ends up in a military installation facility and we get hurt by that, which I understand. You don't want to do that. But to think that we were going to somehow stop China from getting to their eventual place because we were going to stop them from getting NVIDIA chips and other things, to me was delusional. All you were going to do was incentivize them to get there even faster. And that's exactly what has happened. So not two things of that. We have now lost China as a customer on a lot of consumer products that we would sell into. And now we've created a monster in terms of competition. So if you're Japan and you're Singapore and you're Indonesia in a couple of years and you're a company in one of these countries that need to buy some technology to build out whatever, well, China is going to be as advanced as us and probably more cost competitive. So the U.S. is not only losing China as a potential customer, they're going to lose other countries as a potential customer as well. So again, I understand all the challenges with China and what they've done to us and and this and that and where they want to go with Taiwan, which I think is a disaster. And I think it was tragic what they did with Hong Kong. And mortified as a bleeding heart libertarian, what they've done on the authoritarian side and arresting Jimmy Lai in Hong Kong, all terrible stuff. But, trade is trade. And the United States, people here benefit tremendously from that. And so I don't like where this is going. And I just don't think that there's really any appreciation for the damage being done. There's just an incredible sense of arrogance that everyone is going to bow to us on this. And I think it's just much more complicated than that.
Yeah. To be fair to the kind of MAGA people, I think they would argue that it's not necessarily, I think, well, it's tough because sometimes they would argue that it's the deficit with the individual country. But if they heard a well thought out argument like yours, they'd say, well, it's not really about the individual country. It's about the fact that we just have a trade deficit with the whole. And what's that?
In goods only, not in services.
Yeah, and so on net, that
Right, on net.
more of dollars going out, and so therefore the foreigners can buy all of our assets, and then pretty soon no Americans own assets, all the Chinese do. So I think that's would be their argument. But another thing about the tariff that, well, Europe has all these tariffs on our cars, so why don't we have tariffs on their cars? It assumes that the tariff is a net benefit to Europe. And I don't know that that's true. I think that a tariff, although it might protect their industries, I don't know that it wouldn't be a net negative. And the example I use, Peter, is, and I don't know if you know this, but we've got 4,900 peanut farmers in the United States. And the highest tariff, and this was pre-Trump, the highest tariff rate on peanut imports to the United States is 131%. And we consumers, the Americans, buy about 578 million jars of peanut butter every single year. So if you assume that the additional cost to every jar of peanut butter is roughly $2 because of these astronomical tariffs on peanuts, then you have to say, okay, well, the American consumer is paying an additional $1.1 billion for their peanut butter just to support 4,900 peanut farmers. So does this make sense? And so what the argument, what each side does is they'll exclusively focus on what they want to highlight and they'll ignore the rest. So they'll exclusively focus on the peanut farmers being protected. And they'll say, Peter, look, we have to have peanut farmers. These guys are crucial. We have to protect our crops and all these things. But then they completely ignore the fact that Americans are spending an additional $1.1 billion on their peanut butter, and on net, is this a benefit or is it a cost? Well, most likely a cost. And so I would encourage the viewers to kind of wherever you land on this argument, just make sure that you're doing a thorough cost benefit analysis. And when you do that, I don't know, like I said initially, that tariffs are a net benefit for the country who implements them.
I completely agree. And we can look at the countries throughout the world that have the highest trade barriers, and they don't have faster growth because of it.
Right.
Yes, they try to protect certain industries, as you highlighted, what we do here with peanut farmers, but on a net result, their economy is no better off. I mean, the U.S. economy is special, and it's special in many ways in light of the supposed countries that are ripping us off. I mean, India, to me, is a very interesting test case because they have a slew of tariffs. And while India is an exciting growth story, that exciting growth story has more to do with them lowering their barriers rather than having that high wall. You look at their pre-Modi, one of the characteristics of doing business in India was every stop of a supply chain, a tax had to be paid. Call it a tariff, because that's what obviously tariffs are, as taxes. So the producer makes something, they sell it to a middleman. The middleman pays the tax. The middleman sells to a warehouse. The warehouse pays the middleman a tax. The warehouse then sells to another distributor. There's tax there. The distributor ends up paying to another warehouse. And then before it gets to the final consumer and user or retailer, another tax has been paid. So before you know it, there's been 7 taxes that has been paid in between. Those are essentially tariffs throughout. Well, Modi basically just blew up that whole system by creating this global tax where there was going to be one tax. And it was that actually helped the growth rate of India rather than the way that it was. So to think that we're going to all of a sudden sell more Fords or GM cars to Europe because they lower their tariffs to 2 from 10, I think it's delusional. There's got to be a lot more to it. Because as you say, that 10% tariff on us is not really helping them. And in fact, all it does is encourage the US maker just to build a factory in Europe rather than build it here and export it to Europe. So we're not necessarily creating any new jobs here from that. So
yeah, and I think going back to possible better approaches, let's say, is I always use the example of Shaquille O'Neal. Like China is Shaquille O'Neal. And what we're doing is we're saying, okay, in order to compete with China, because they cheat on labor, they cheat on the environment, they cheat on all these things, the IP, you talked about that. We need if we're playing a game of one-on-one here in trade, well, then we have to have some guy that's 7'2". We have to. I mean, look, Peter, China's 7'2", Shaquille O'Neal's 7'2". So we've got to have someone that is at least that height, or we're never, ever going to win a game of trade, or we're never going to win this game of one-on-one. But my argument is, well, we actually have Michael Jordan as far as the U.S. economy, and he's not 7'2". Let's just say he's 6'6". But guess what? He's a lot more skilled, and he's a hell of a lot faster. But unfortunately, what we've done to Michael Jordan is we've put this ball and chain around his ankle, so which is regulation in my view. And so if you could just get rid of that regulation, and ironically, if you could create more certainty, not less certainty, then you would have these U.S. businesses doing what they do best. And would they be able to compete them at that 7'2", or would they be able to compete with them at that 7'2" level? No, but we could still win. We still would win because we have the superior economy if we just unshackle it from the bureaucracy, the red tape, etc. That's kind of the analogy that I always use.
So I agree 100%. And I'm going to take that and sort of swing it back to the question of how do we help those communities that have lost jobs because of closed manufacturing facilities? Well, Trump made a very good step towards that in his first term when he cut the corporate income tax rate from 35 to 21.
Yeah.
Well, what about lowering that to 10 or 15? Because at the end of the day, a corporation's not really paying the tax. They're just passing it through to the rest of us. So lower corporate income tax rates further deregulate the economy. That's how you make us cost competitive.
Yeah.
Because that's how you encourage U.S. industry to come back to the U.S. Because if you brought back U.S. industry with that technique, well, then we would be cost competitive and be able to not only sell within the U.S. market, domestic market, but would be able to also export that throughout the world because we have a very low cost base. So
And then you do that manufacturing in the United States as opposed to set up that manufacturer outside, right?
exactly. So that that's a much more effective way, and we would expand our markets rather than putting up these walls.
Yeah.
So I agree 100%, and I think that I thought was sort of the hope for path. I mean, even Trump talked about lowering the corporate income tax rate for manufacturing down to 15. Now, I don't like picking and choosing, who gets that lower rate. I think having an across the board 15% is better than 21, which is better than 35. But that's how you benefit U.S. manufacturing, not just domestically, but globally.
Okay, so let's
Under the regulations that you talked about.
yeah, let's move from the economy over to markets. So I think today the Dow, when I checked, was down 700. I looked at the S&P 500 over the last 3 months, and I think we're down 15% or so. I mean, the chart obviously doesn't look good. So there's a pretty good probability that we go into a bear market. What's your take on equities? What's your take on bonds? And obviously, we got to talk about gold being at all-time highs. And then whatever your take is on the stock market, what I always try to think through is how does that impact the economy? I think you hinted at this earlier, where unfortunately our economy now is completely dependent on these asset prices. So, what happens to aggregate demand if the S&P 500 goes down by 30%? And heaven forbid, if the unflappable housing market goes down by, 2 or 3%. I did a video the other day, and I saw that the market cap for the U.S. housing market right now is $50 trillion. So unfortunately, a 2% decline in nominal terms means there's $1 trillion that has been wiped off the balance sheet of the American consumer. So what are your thoughts on markets?
So I'll start with where you sort of finished, in that asset prices are directly connected to the economy and vice versa. They're tied at the hip. And we know, and I've been saying for a bit now that the US economy has really been resting on three pillars of strength: government spending, excessive government spending, anything related to the AI capital expenditure ecosystem, and upper income spending. And every day you get a market decline and you're going to chip away at that upper income consumer. And there was an article, I think it was Friday's Wall Street Journal, talking about how upper income buyers are all of a sudden backing out of home purchases because they're getting shaky legs and they don't want to pay $10 million. So they're backing out. So you can basically clinch a U.S. recession if this downdraft in the U.S. equity market continues, which unfortunately I think it will. I think we're just in the early days of a bear market. And, one of the problems with the U.S. market, it's really started before tariffs came about. It was the U.S. market that lost the Mag 7 AI tech trading.
Right.
And really started, I think, late last year. You can see that in the performance of Microsoft, where the market started to sort of pick out the aggressive spenders in AI and how that was eating into their cash flow. That Microsoft, to use them as the example, was this cash flow rich business that all of a sudden started to become a capital intensive business. And then questioning, okay, well, you're spending all this money. What's the return on all this spending? And then, of course, the DeepSeek news in late January.
Yeah, that seemed to be kind of tipped her over the edge.
That's what that was the nail in the coffin of the Mag 7 trade. And then now here we are. The Apple intelligence upgrade cycle never really happened. Google's search business now under threat from ChatGPT and Perplexity and others. Tesla, obviously, their auto business challenged, and people were wondering where with Elon Musk managing so many different things. Amazon now, okay, well, they have a lot of third-party sellers that source product in China. What's the fate of those businesses? So to me, that trade is dead in terms of this outperformance and their ability to carry the market with them. That's 35% of the S&P. So we've lost 35. We've lost the leadership. So that creates major fragility in the overall stock market. Now, that doesn't mean that there aren't other places to invest. International stocks are way outperforming U.S. stocks. Now, economies around the world are not going to be immune from a global trade war, but those stocks have been left for dead for the past 10 years. And I think that there are a lot of opportunities to be had in a lot of international markets. And that's where I'm really tilting my focus to, is finding those stocks to buy in those markets, because I just think the US has lost its leadership. And now the US economy is likely rolling into recession. And, again, you get that self-fulfilling prophecy. Stocks start to discount the possibility of recession, the decline in stocks enhance the odds of a recession. Then you get a decline in earnings. And now everyone's questioning, where's the PE multiple going to settle out at? And I can promise you it's not going to be 22 times again. 22 times was when everyone wanted a piece of the US market, both business wise and asset wise. You go back to, and I can't wait to see the updated 13Ds and 13Fs, which I think are going to roll out pretty soon. But if you look at these filings as of December 31st, foreigners were big holders of US stocks. In fact, according to Torsten Slok's latest chart, not too like last week, foreigners owned about $30 trillion of US stocks, US corporate bonds, and US treasuries. And you even had central banks that were big holders of US stocks. You go back as of December 31st, and then the investment arm of the Norwegian central bank owned all the Mag 7 stocks.
Yeah.
They were one of the biggest holders of many of the Mag 7 stocks. They were the 10th biggest holder of NVIDIA.
Yeah.
So that trade's over, and they're selling, and that's why you're getting the sell. And you can, even before the latest sell-off in the dollar over the past couple weeks, you can look at the dollar index over the Mag 7 index, and over the past 12 months, up and down, they pretty much have followed each other. So there's clear selling of U.S. assets, which of course is, if you want to shrink the U.S. trade deficit, you're also going to shrink our capital account surplus, and there's going to be less international dollars flowing into U.S. markets.
When do you become a buyer of the S&P 500? Like, I know you've been doing this a long time, and I know that you're area agnostic. Like, you're just focused on making money.
Yep.
And so what metrics do you use to determine, okay, the U.S. is looking interesting again?
So valuations don't matter until they do. They don't matter when valuations are high, because they can stay high. You need a fundamental change in the thesis to break that high multiple. And on the downside, valuations don't matter until they do. An 18 PE can become a 16 PE, can become a 14 PE, can become a 12 PE. I don't know where the PE will eventually bottom out at, but each multiple turn that falls, is a major reduction in that stock price. Or that, for the S&P, it'll probably be less than this, but the current earnings estimate for this year about $250. I think probably be less than that, but that implies for every 1 point decline in the multiple being paid, that's 250 S&P points. So when we get to, call it 15, 16 times, even down to 14 times, I'll say, okay, on a multiple basis, again, figuring out where that E is, I don't know, but okay, things are starting to get interesting. And then, okay, what is sort of the fundamental catalyst that can sort of create it to that bottom where it can be even more interesting? And it's clear right now that tariffs are front of focus. Blowing up the global supply chains are occurring. So any major reversal in that would be enough to say, okay, maybe there's stuff to buy here. Because they're, even in the US, we own, and I'm finding, cheap stocks that are, very domestically focused, or more insulated from, global trade wars. But cheap can get cheaper, just as expensive can get more expensive. But no one's smart enough to pick a bottom. But valuations, domestically based businesses, I find them attractive now, some of them. But the S&P headline index, because it's still dominated by those names, just as we know in history, George, we've seen decades of consolidation and digestion from periods of dramatic outperformance in a particular group. And maybe we're in a multi-year period of digestion, consolidation, and rotation into other things from what has led us before.
What's the typical process you use, Peter, when you're analyzing what to buy? Do you start with the company or the commodity, and then you have like a macro overlay, and then maybe for timing you use technicals? Or how do you do that?
So because I like to invest in long-term compounding businesses, but at the same time, I like to invest in commodity stocks and try to ride a particular cycle. That's not those are more rent to stocks, not like close your eyes and buy forever stocks.
Hmm.
Those sort of rent to stocks, I love buying commodities at the bottom of a cycle. I love to buy oil stocks when oil's at $60 and nat gas is, $2 to $3. And I love to buy fertilizer stocks when corn's at 4 instead of 6 to 8, when soybeans are 10 instead of 15 to 20, which I think you have an opportunity here to do. Now, precious metals, they're up a bunch, gold's up a bunch, and I'm still riding that. So I can't necessarily use that analogy with that. But I think with gold in particular, and I know you wanted to get around to it eventually in terms of discussion, there's still so many fundamental factors that are positive that I think the price still surprises to the upside. And talk about underperformance. Silver is the poster boy for underperformance. Even platinum, which is one of the newer metals that we've recently bought, that is a poster boy for underperformance, that it's down by half from where it was 14 years ago. On the flip side of trying to find good businesses that are potential compounders, that I like to buy because it allows me, if I believe in a long-term business tailwind and a long-term thesis, it allows me to block out a lot of the short-term noise. That I think if a company has a lot of market share to take in a business that's not going to get disrupted by technology, that's not going to get killed by lack of trade with China, for example, and a long-term winner, I'll sit through any short-term pain that comes of it. And in fact, invite short-term pain because that allows me to buy that thing cheaper. So I focus a lot on the actual business. Is it a good business? Is it a good cash flow company? Does it have that, competitive defense to its model? So those are the things that I look at, a combination of these things.
And does the macro come into play when you're looking at geographical locations or sectors?
It does. I laugh when I hear Warren Buffett say, I don't pay attention to the macro. Meanwhile, he's one of the biggest holders of an oil company. He owns a railroad. You have no choice.
You've got $33 billion in cash.
Yeah, of course you're focusing on the macro. I think that's the best way to invest is to merge the macro with the micro, is understand the nuts and bolts of a business, but also understand the state of the business that they're in. You tell a kid, when they go out on their own, or they go out at night, be aware of your surroundings. Well, we always have to be aware of our investing surroundings, both at the macro level, the micro level, in terms of the management. You have to pay attention to the macro. You have to merge that into your thesis. We had owned FedEx for the last couple of years. And in March, when this tariff rhetoric started to really heat up, I said, I can't own this stock in this environment.
Right.
And we sold it. And I'm glad I did because it's lower, about 20% lower. So you have no choice but to merge the macro and the micro.
On that note, are you a little concerned? I know you're very bullish on silver, but do you hesitate a little bit because of the industrial component there potentially going into a recession?
So that's definitely a factor, but I think the offset to that has been very muted supply of silver.
Okay.
And I think it's also, we know silver is also a byproduct of gold. Gold supply is only 1.5 to 2%. So if your supply is only about 1.5 to 2, and there's only so much supply generally you're going to get even with that demand hit. But yes, that is a risk. We own copper, not directly, but some of the gold miners that we own, where copper is a byproduct. And I wonder, okay, how's that going to affect copper too, since it's obviously very economically sensitive. But, there's been a lot of supply discipline in a variety of different things that I think could sort of be an offset. And that when you also look at, major macro global monetary inflection points, which it seems that we're in, and global trade inflection points, commodities tend to do well. And, take silver, for example. I mean, with this, the U.S. initiating a critical minerals review and China limiting our access to rare earths, like having your hands on key raw materials is extraordinarily important. And I want to own those. I want to own silver, which is the key manufacturing input, and platinum, which is the key manufacturing input. I want to own these special commodities that are in greater demand in a what is seemingly like a a scarce world in terms of the ability to easily get your hands on things.
Right. So there are risks, but the risk reward makes sense.
Yeah, and a lot of them have been beaten up. I mean, silver at $33,
Yeah.
you inflation adjust that from where it was just in 2011, you're back in the envelope gold to silver ratio. I mean, silver is cheap.
Yeah. Right. What do you think about uranium?
So we've been bullish on long uranium too for a while. I know the spot price has fallen down to this mid 60s, but the contract rate is still pretty generous. And I still think if you look at the supply demand imbalances for uranium, it's still a very wide deficit for many years to come. So I remain bullish long uranium.
Do you play that with the Sprott fund?
So we've owned Cameco for years, and we do have the Sprott fund also to sort of get a diversified mix because, at the end of the day, mining is a difficult business, particularly, the gold mining industry has probably destroyed more capital than any industry in the history of the world. And I do like to own the well-run businesses in that, but I also like to own the ETFs that just provide some diversification because you just don't want to wake up to some mine confiscation. You don't want to wake up to some, tailings issue. You don't want to wake up to something that comes out of nowhere that seems to happen when you own a mining company. So I acknowledge that it's a brutal business, and it's also good to own, diversified basket in addition to some of your favorite names.
Okay, $60 or $60 trillion question. Where do you think Fed funds is at the end of 2025?
So I think that's I wonder. Now I know Trump today on the day we're taping this called Powell a
Loser.
loser. That's not the kind of approach that you take if you want someone to do what you hope they would do.
Yeah.
Like I said earlier, I think Powell is focused on his legacy, leaving in May 2026, not walking out the door, being accused of kowtowing to the president and watching your inflation fight blow up again on you. That said, he also doesn't want to preside over a 5 to 6% unemployment rate with him doing nothing.
Right.
So right now, the Fed funds futures market pricing in, call it about 3.5 rate cuts this year. I think I can say that's fair. Take it to like 3.75, 4 range, which is fine. If he does that, the days of going back to zero though are over. You would take a 5.5 to 6% 10-year yield for them to step in to do QE again. And I'm not.
So you think we'll have to get the 10-year to have to be at over 5 before they do QE? You think?
I think yes, because I think that is a lever that after the experience of ramping up during COVID, particularly with mortgage-backed securities,
Right.
I think they're going to be more reluctant to use that lever like they did before. You also have Jeff Schmid on the committee from Kansas City, the Fed president, who is anti-QE. Now, he's just one guy, but I think there are a few others that just don't want to use that tool like we had in the past, unless you get a uncontrollable spike in long-term yields. If the 10-year yield goes methodically higher, that they're not going to respond to. If it goes uncontrollably higher, that's when they will step in. But then the question is it just a temporary thing like the Bank of England did when the LDIs blew up? Or is it going to be more of a sustainable thing? And I think the circumstance will determine that. But I do think that the Fed hates having all this MBS on their balance sheet because they see what they did to the housing market. And for that first-time buyer, it was nothing good.
Yeah, but see, that ties into what we were saying earlier with unemployment. I mean, assuming the bank's going to take a higher risk premium on the MBS, that means mortgage rates could stay the same or even go up if you're dropping rates on the 10-year. And then how does that apply to the $50 trillion in aggregate demand? And it all goes back in a circle, doesn't it, Peter?
Yeah, I mean, there are a lot of risks this time around for the Fed cutting. I mean, what did we get the first time they cut 100 basis points, in stages? We got a big jump in long-term interest rates. And who's to say that doesn't happen again? Who's to say that the Fed cutting short-term interest rates is not the trigger for a rise back to 5% in the 10-year?
Yeah, at the end of the day, for me, especially at the long end, it's all about growth and inflation expectations.
Right. Under 90 DXY.
Yeah. Peter, how can people find out more about what you do?
So on the wealth management, asset management side, they can check out our website at bleakley.com. And on the macro thought standpoint, I write the book report on Substack, and they can check that out. And it's BOOCK report as a play on my last name on Substack.
Awesome, buddy. Thanks for your time. Always enjoy the conversation.
Thank you, George. Same here.
Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.